Good evening, guys. Welcome back to Finance Lingo once again. In this video, I'll be talking about this coming IPO, Link Trust. So, alright, let's start off. Okay, this presentation is provided to you for general information only and does not consider recommendation, an offer, or solicitation to subscribe for or purchase or sell the investment product mentioned herein. Okay, so let's start. Okay, here we are. This is the Netlink Prospectus. The share price is offered at 81 cents per unit. Okay, to obtain a copy of this physical this prospectus, you can go to the bank branches and ask for the Netlink prospectus, or go to Raffles Place. I believe they have set up a booth there, or all right, just goes to this MAS website, mas.gov.sg. Scroll down, click Opera. Once you are in Opera, click the business choice. Okay, then you will be presented with the Netlink NBM Trust. All right, so it's a party of issuers managers to issue these shares to the public. All right, so you just need to click this, and thereafter, okay, click on this prospectus. You can download and see a copy of this. All right, so let's start off. So what I'm looking at here today is that the going to this paragraph here. Okay, so here we have is a 2.8 billion shares offered at 81 cents. Okay, of which let me see, some of them is offered to public and some of them to some of them offer to placement, some of them public. I'll go through the breakdown later on. Okay, so let's start. I'll go to the next page, page 8. All right, so here we are, page 8. Okay, this is the opening date, 10th of July. Now the video is recorded on the 12th of July. So okay, the closing date is 17th of July, 12 noon, and the commencement of trading is next Wednesday, 19th of July. All right, so let me just enlarge this, but honestly I don't think there's a need to hurry. Okay, so you can just go to any of these ATM to apply for the shares. Okay, so what I understand, just to highlight first, is that my understanding is DBS have greater allotment. If you really think that the share price go up, do go to DBS Bank. I think it's a better chance, but I do not think that this is a very good share. So I just think that it's moderate. Yeah. Okay, so this is page 8, date of listing. Now let's go on to page 71 and 72. Okay, page 71. So this company raised the money by issuing shares for what purpose? Okay, so what we can see here is the purpose is that they are going to take a fraction of the money and pay back to Singtel for acquired that fraction of their business from Singtel. And secondly, they're going to repay some amount onto the SD facility agreement. I will elaborate the SD facility agreement. So basically, about of the proceeds, the money raised from this IPO, summarized is paid to Singtel and this SD facility. This SD facility is two more parties. So the rest of it, I don't seem is a much of a concern. This is pretty common, such as the fees payable to the bankers. All right, so the rest is not a concern. These two paragraphs constitute the bulk of this IPO. Okay, so now we're going to page 75. Okay, so here we have, this is the shareholding statistics after the issue of this IPO. So after the post IPO, okay, what we are looking at is that Temasek will be holding 25% of this company, okay, and the public and the institution will be holding 75% of this. Okay, so what I have to comment here is that some people may think that, wow, Temasek is here, this should be a pretty good one. I'm sad to say that there is a concern here. Okay, I'll do more in details later. What the concern at this point of juncture I do see is that there is a huge public and institution investors right here. So what is the big concern? I do think that because of this reason, this is will cause the share price to come down. There is a very likelihood that you will come down because of this 75% rather than 25%. This one, I know they're not going to say anything. They're not really going to hold the share and just sit down there for the next 10-20 years. It's very likelihood because this company that their IPO is to buy over from Singtel, and it's already belonging to Singtel already, so it doesn't really make a difference. They just reduce their holdings of this company from 100% down to just maybe 25%. So that's to say, you can say that this company Singtel sold to you the other 75% of it, and this Netlink will remain having Temasek as one of the core shareholders. Okay, so I think that is this 75% that will cause the share price to come down over the next few weeks, right? So that's what we're looking at. Now let's go on to page 77. Okay, this company is rather unique. Okay, it's not like an ordinary private companies or limited companies, because they are paying out dividends not on the earnings. I need to repeat, they are paying out the dividends not on the earnings. The detailed breakdown will be explained later. So they are putting it as distributions. So you can notice that there is a change of jargon as compared to other IPO. So okay, so their distribution policies is as follows. This is on page 77. You can read through that, okay, but I'm just going to summarize that because I know there's a lot of technical jargons inside. Okay, NLT refer to Netlink Trust. Okay, the rest a lot of more jargons, and they're using some other form of calculation methods, which is a non-financial reporting standards. Let me highlight here, non-financial reporting standards. FRS means financial reporting standards measures. Okay, so I do think that they are trying to probably outsmart the market. They are using their own form of measure tools. Well, in terms of this, I cannot say that you're wrong. Neither do I can say they are totally correct. Okay, from my experience, I would say that they are wrong. But from the rule and the law point of viewpoint, it's not wrong. So it's kind of hard to say here. All right. So I'll explain to you what I'm talking about later on. That's because there are a lot of very new things as mentioned in this IPO. Okay, so what we are talking about is distribution policy, not dividend policy. This is in this IPO. This one is very critical. I do notice it does make a difference between this IPO and the rest. So investors should not see this as ordinary dividends payable from the earnings. Okay, now next we are going to page 80. Okay, page 80. Okay, here we are. This is the balance sheet of this Netlink Trust prior to the IPO. Okay, so here we can see that the cash flow on hand is not pretty much at 92 million on hand. Well, at least it's pretty okay lah. Okay, the assets and the property, plant and equipment. I do need to comment here that we are looking at the bulk of plant and equipment. So this is the fiber optic lines laid across the entire Singapore. Okay, you do not. This is 2 billion worth. It's very difficult to set up such companies. Okay, that's good on the bad and the bad side to it. Okay, but I don't think that's the main concern of this IPO. Okay, next, the one of the big concerns here is this. Okay, this is the loans that Singtel has taken up, and the so-called the SD facilities had also agreed with them, and the bulk of the IPO, I say it again, the bulk of the IPOs will be used to repay back these loans. Okay, this is the loans that is used to acquire all these, lay out all these network lines. So this is an infrastructure, a network infrastructure. So these lines have been laid, okay, and it takes a lot of money and a lot of time. And this is the loan taken up to build out this company. And it's only Singtel is able to initiate this company. So now this company have come to a reasonable size, and now they are trying to sell it off, sell a fraction of it off. Well, just like Singtel when it first started off, government gives you a Singtel share. Now they are giving you a Netlink share. But instead of giving you free now, this time is different. This is considered a private company, a limited company right now. So no more free Singtel shares. Okay, so here we have, okay, this is the bulk of the loan that we used to pay. So I'm going to jump a little bit here. Okay, let's just bring this in. Okay, the total numbers of units issued here for this IPO will be 2.89 billion. Okay, so in the share price, we come out that they are trying to raise 2.347 billion. Okay, from the page 35, you guys can read through that. Okay, 185 million shares will be issued to a public. Okay, so the difference here will be the rest will be institution, referring to the fund managers, JP Morgan, Morgan Stanley, Credit Suisse, UBS, whatever. Those big funds, they'll be subscribing to those areas, and public like you and me will probably looking into these regions. Okay, so for the public, they are only looking to raise 149 million. Is it small? No, it's not small. Okay, this is equivalent to really maybe 2 or 3 Kimley, the recent good IPOs listing. The amount is quite significant, of course, and I do see that there's a huge institution over here. Okay, so yes, so where do I see that they raised 2.3 billion here, and 1.6, or I think it's close to 2 billion will be used to pay off these loans allocation over here, so that once this IPO is raised, these loans will be significantly reduced. Okay, and then the net assets will be significantly increased. All right, so okay, that's a do. Now just let me put this back. Page 80. Okay, now let's go to page 81. Okay, now let's take a look at the profit and loss statements, or you can call it income statements. Okay, net of net, they just work out based on the pre-IPOs. Okay, this is the revenue they earn, blah blah blah, minus 40, blah 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 blah. They come up to a net income of 73. Okay, so this is the part, if you are just based on ordinary business, this will be really shocking. Okay, earlier I mentioned they raised 2 billion worth of money, and they're only making 73. If you take this 73 and divide it by 2 billion, the PE ratio has come out to be a shocking 80. So okay, I said shocking 80, or maybe 70 plus or 60 plus. That's very, very crazy high. Okay, but from the banker viewpoint now, they do not think that this is a proper model to put this on IPO. This is wrong. Okay, that's what they think lah. I will say that I have my thinking lah. Okay, now let's go back to this, but so you can see that official earnings based on common business, this is 73 million, which is considered very, very low for a 2 billion IPO. Okay, but well, let's go further. This do not conclude your viewpoint here. Now let's go to this page 81 and 83. Okay, this is the cash flow statement. I will want to skip it. There's a lot of details. I'm going to summarize and jump straight to the end, easier. Okay, now here we are at the page 83. This is one of the core component of this prospectus. I think yeah, this is the place whereby a lot of people may misunderstand what they're trying to say. Okay, so what we can see here is that, okay, what they're going to do is that this company is going to pay out the dividends based on the cash flow. Okay, just like I said, you're not using the traditional methods. So what they have is that they are going to determine the depreciation of this company, okay, and the finance cost. Okay, those are the interest that is being paid to the how do I say, the loans. All right, because when you use your IPO proceed to pay off the loans, you don't need to incur all this already. And depreciation of fiber optics, it really doesn't make sense. Fiber optics is really going to last there for 10, 20 years, 30, 40 years. Okay, it's just plastic. Okay, you don't depreciate plastic, but on the formal accounting policy, you do need to depreciate. So there's a fight between the accounting policy and the common sense. Okay, so here they are trying to depreciate the fiber optic lifespans based on how much they have installed and the lifespans. Okay, so it makes sense to depreciate, but they're going to add back the cash flow. So this instead, they are going to use this amount, so the profits plus all this irrelevant stuff. So this one makes up the core, come out to a cash flow of 220624 that can be used to distribute dividends. Okay, so do notice that they are not distributing earnings based on here. They are distributing earnings with all these differences, but I'm not going to calculate this small one, but they're going to take this depreciation and pay out as dividends. So yes, here we are, that's the trick here. Okay, so now let's go back to page 87. Okay, page 87. Oh, I can't remember page 87. Okay, so yes, what you can see here is that here's the depreciations. Okay, they are trying to make all the adjustment for depreciations. So this is in the depreciations on the plastic. On the formal accounting policies, you need to take into depreciation, but likewise you depreciate a plastic. So what does the plastic disappear? No, the plastic will remain there. Okay, the optic wires will still remain there, although there's you need to depreciate. Okay. So here we have and the finance cost. So a bulk of it, because once you paid off the loans, you probably don't need to cost so much anymore. This thing will literally disappear. Okay, interest paid. Okay. So okay, these are the unit holders loans. Okay, so once you go IPO, I think yeah, that's what they're trying to say. I didn't read fine details, but it's very obvious. Okay, so once the IPO goes in, the unit holders loans is gone. All right. So acquisition of subsidiaries is also gone because this one is now become the part of the company. So this one no longer belongs to here. Okay. So next, earnings per share in 89. So yes, this is the based on the traditional accounting way. So do look at that. They based on the, if you're doing it like a traditional business whereby your dividend is distributed out of the earnings per share, look at this company. This earnings will be horrendous. 81 cents share. You're giving only 1%. 1 cent. That's ridiculous. So they will take this and plus back the depreciation, which is the money the company retains and give you out as dividends. So do take note of this. This is earning per share. This is crazy low. Okay, and I do not like such low numbers. Okay, now let's go back to page 91. But of course, this one doesn't function like a traditional business. I'll give you my viewpoint later on. Okay, so on the page 91, here, okay, they do a forecast period and how much dividend they're going to receive. Okay, so what I can see is that the forecast period at the earnings for 2018 was $37.3 million. So you can see they add back to depreciation plus all the amortization. Amortization is a form of depreciation, but well, this is accounting. You don't need to care about it. Just take it as it's just another form of depreciation, right? So blah blah blah. They're gonna buy some properties. Blah 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 blah. Okay. End of the day, this is the amount that considered the cash flows lah, huh? So they can distribute. They are intending to distribute all this amount for dividends. Okay. This one is just some small expenses. Now net, they are going to pay out this amount as dividends. So distribution payable. So notice that how come depreciation they are used to pay out. So yes, they are going to take the depreciation and pay out as dividends. So yeah, you can see a pretty decent 5% dividend, but there's some side effect to such scenarios. Okay, I think only most of the time if Singapore is the one only using such method. But let's take a further look. Okay, now this is page 91. Now 92, page 92. Okay, page 92. Here we are. Okay, this one gives you the revenue breakdown by sectors. Did I miss something? Just let me hold on. Oh, I think I missed something. Okay, page 92 just tell you which is the components of that's generating revenues for this company. Alright, so you can see the bulk of it is all these residential connections, and the rest is just business non-residential connections. Some manholes, networks. Alright, inside. Okay, there's another one that says the page 92 revenue income blah 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 blah. It tells you the Singtel and Monster how much they pay them. Okay, I can't quite remember, but never mind. Okay, so let's get back to here. So you can see here is that the total revenue that they get from for the forecast periods. Alright, so I can see that well a lot of them have contracts, so it's pretty easy to do a forecast on this. no hard and fast rule on this. Okay, so this is the revenue income. Next is going to page 124. Oh yeah, the Singtel amount styles will be later on as page 160, but I'm going to go on page 124. 124, 124. Okay, so Singtel. So as far as I can say, bulk of it, the money will use to pay for the Singtel. Okay, to buy over this business away from Singtel. At the same time, Singtel is going to buy back this a fraction of this company at 25%. So it's quite a funny left to right hand, right hand to left hand kind of thing. But now then you can see that the acquisition cost, how much to buy this buy this business away from Singtel. Okay, so this is the amount. Okay, right. So this is the acquisition cost to buy over from this business, and they need to use some of the money to pay off the loans, right? Trust acquisition. This is page 124. Right now, page 137. 137. Okay. Now this page have one very important thing. Okay, this might look like a small little thing, but it's going to be very important in my decision here. Okay, I'm just going to come to this paragraph. Okay, while the typical accounting life of fiber cables are 25 years, in practice this physical assets last much longer, especially in the case of trust group. Okay, so yes, now we can see that they are depreciating based on the 25 years. It's common sense fiber optic should last more. Okay, no doubt this is just plastics. But we do not know 15 years later is there any technology that will arise to compete against this. Okay, so yes, I think that maybe 10-15 years are likely because this is on the 5G, 4 or 5G. I hopefully not. But if there is, this trust become in great risk. I do think that the chances is low, very low, but we never know because like the coaxial cable is going obsolete, and this was really installed by maybe the MDA as well. So yeah, so they are depreciating based on 25 years. Okay, do take now here 25 years. I'm gonna put this here because this is one of the calculations that I'll be using later on, which is critical on the judgment call whether to buy or to sell. Okay, yes, it's very critical. So now we're going to page 160. Here we are. Okay, this is the revenue contributions for 2015, 2016, and 2017. So I'm just going to ignore the fund 516. Okay, I'm just going to jump straight to 2007. Okay, I'm not interested in what happened in the past. Okay, now revenue. Singtel's contribute 152 millions to this trust, and Nucleus is StarHub, okay, 85, and M1 36, My Republic 15, and ViewQuest 4. So this is the amount. This is the main customers. So if I can see, Singtel remain the bulk as the main customer. Okay. So okay, other than that, let's go on 267. Okay, based on this plan of distribution, what they have stated here is that pretty interestingly, DBS has a higher allocation. Next, private banking, Morgan Stanley, and UBS. All right, followed by all the respective smaller investment banks and banks. Okay, Citigroup, HSBC, OUB, and UOB. Okay, here Philips, you are not going. There's no placement for us lah. So, but I don't think that you need to go for placement lah. Seriously. So all these are targeting the really the big players if they really want to buy about 1 or 2 million worth of this company. Yes, these are playing in the bulk. So, but and Philip, I think if you want to have this share, no problem going on fighting on the public trend. It's very easy. So okay, here let's say if you really want to go on the Mati must have this share. Okay, insist to have this share. I think DBS offer the greatest opportunity. All right. Apart from that, even if they cannot fulfill at the ATMs, I think this maybe a fraction go to the public trend as well. Okay, they may just sell it to the customer at the DBS because, right? So, but of course, I think this offer is pretty easy to obtain a share. Okay, 267. Now next we are going to take 299. This we're going to break down what is the ST facilities. 299 ST facilities. ST. Okay, the ST facilities is the loan agreement between Netlink and these few parties. Okay, it's a 1.325 1.3 billions. Okay, loan between taken from CityNet and Singtel. Okay, so the bulk of this bulk of money will be paid back to them. So this loan will literally disappear from this their accounting. Okay, so that means the interest they have paid to them will become part of the dividends. Okay, I say again, the interest they have paid to them will no longer be required to pay interest to them because you pay back them. So that was why. Now I'm just going to go back. Alright, go back to page 81. Page 81. Am I in page 81? Reconciliation or 83. Okay, that's why they all depreciations at the depreciations. You know, they'll add back the finance costs. Yes, so you can see the finance costs they need to add back. So these are the become part of the earnings because you no longer need to pay them, and since you pay back the loan, so the interest they have been paid in the past you will need to add back to derive something. Okay, so now let's work out the rest. Okay, now that we have all the figures, now let's go on to the rest and my commentaries. Okay, so here we are with reference to the earlier pages. I'm just going to enlarge this. Let me see. Okay, so let me reiterate. So it refer to page 81, 83, and 299 of the IPO. So from this one, you can see that the IPO proceed is to buy over the loan. The wire lines installed is expected to have a prolonged lifespan, which 25. On the formal accounting policies, as I mentioned earlier, depreciations, okay, you need to be formalized on the accounting, but they need to add back the depreciation because they think that it's not relevant. Okay, hence the depreciation money doesn't disappear. Okay, as the money just you depreciate on the accounting, but doesn't mean the money disappeared. Okay, this money will be used to pay back as dividends, and the money of IPO, okay, hence the depreciation and loan interest, okay, is subsequently available for payment as dividends, for distribution as dividend. Yeah, okay. Now referring to page 71, 72, and 880. Okay, so in this case, okay, what did I vote? I forgot. Net asset plus loan. Okay, page 71. Now let's go page 71. Okay, so they tell you what they're gonna do. Okay, so before we go to the details, settlement of the cash component of aggregate payable to Singtel and Trust. Okay, ST facilities, and this is some material contracts, whatever, very small figure, and pay to the trustees, and the bankers' costs and expenses. Okay, and some equity issue expenses. Okay, so now let's just page 72. Just let me. Okay, now yeah, 72. So this one is based on for every dollar that you paid, how much goes to pay for the whatever thing that's underlying. Okay, settlement of cash component payable to Singtel. So every 46, for every $1 you put, 46 cents goes to Singtel. For every $1 put, 47 cents goes to pay the loans owing under the ST facility. Okay, repayment of the principals owing under ST facility. Just this one, the other 4 cents, which is less of a figure, used to pay for the lead-in ducts. I don't know, I think some tunneling things. The rest will be not significant, not material. Okay, payment of the trust. So every $1 you paid, 3 cents go to the book runners and the banks that is helping this raising of this IPO money. Okay, so here we are. So next, page 80. Okay, so here we are trying to calculate the NAV. Okay, so okay, prior to the IPO, okay, this is the equity value of the company. Okay, the entire prospectus, they didn't attempt to work out the NAV. Okay, I think that they think that's irrelevant. Okay, now, so what we can see is that they raised a significant amount of value. What I can do was just to do an approximate. All right, so from here, from these statements, I know that these loans will significantly disappear, a big chunk of it. So I know that there's for the almost half of it, okay, of the more than half of the money as shown earlier. Where is it? 71, okay. No, 72. Okay, 46 cents and 47 for every $1. So this add up to be 90% is used to pay back this few parties. So hands off, I know there will be some premium over it. So let me go back, page 80. So what I did was 265. How do I say? Okay, 265. Okay, plus this, removing these assets here. When you remove this one here to 0, this will mean that the net assets will go up by the same magnitude. So it will be 1608 plus 265. 1608 plus 265 equal to 1873 as the total equity value. Okay, I repeat, your IPO proceeds, the bulk, 90% of it, will be used to remove this 1608. Hence, once you remove this one will go up by the same magnitude, 1608. Net of net will come to 1873 of the NAV. Okay, you are paying for some assets, which is part of it here. So 2.8B minus this thing is gone, probably 1B, so you should have 1.8 something. So yes, 1.873 divided by the total number of units, we come out to a book value of 64.6 cents. Hence the share price 81 cents divided by 64 cents, it come out to a book value ratio of 1.25 ratios. So I said again, this is approximate, but I think that is a pretty good, decent approximate since they never calculate for you. I calculate here. Okay, I do have a hard time trying to work out all this. Okay, next, just now we can say that there's a 25 years lifespan on this. Now this is one of the critical part. Okay, depreciation is based on 25. Assumption that there's a big assumption here. You're assuming that the fiber optics will last 25 and there's no future technologies going to replace it. Fair enough, I know optics is pretty fast. Okay, so I maybe just let you have the benefit of doubt. So now 25 years, but I'm not assuming that that's it, 25 years, new technology come in until 25 years later. Come in, I said, they come in, it makes the old technology obsolete. Okay, I really don't know what technology come in. 25 years is too far. So hence, if I assume the IPO price at 5.43% dividends come 25 years, I come to a break even, maybe I get back 135 of what I have paid. So hence I'm only getting back 35.75 extra. Thereafter, the 100% I paid in become obsolete. I just get back the principal as some returns. So where this cable is all fully depreciated, hence I'm only getting a 35% premium for 25 years. Oh my god, that's horrible. Okay, so I say it again, you can, common sense will tell you 5.43 of 25 go to 135. This is a break-even point plus a little bit more. 25 years plus a little bit more. Okay, that's horrendous. Now the major shareholders. Okay, just now I said it again. The major shareholders is the Singtel's 25%, and I do expect, maybe 10 years later another chief of army, chief of air force coming take as a CEO again once again. Okay, but having said the earlier on, I will give you some good compliment later on. Okay, so the dividend policy, okay, this is doesn't meet as a dividend policy. In this time is distribution policy. It is the net profit plus depreciation plus the loan interest payable previously. Now add back, so all this become all this add up become the dividends. So here we are, because thinking into consideration that optic is plastic and plastic doesn't depreciate to zero, but formally you must depreciate, kind of what you're talking about. Okay, but you get what I mean. Plastic doesn't depreciate, but it is formally we do it for formality's sake. Okay, so here we are. This is the dividends payable. So for some recent case study, you guys can read on the price likelihood movement. Okay, read on Link Trust. I know that this is horrible. I know you all will curse and swear on this company. First ship list did horribly, but I really don't know what's going on, if it's going to come back alive or not. Now this another one is the Asia Pay TV. It has very close similarity to this IPO. It's, I would say, 90% similar in model as well. So do check on the share price movement and you'll get what I mean. Yes, the share price may not do very well, but there is a good buy point sometimes in the future. I've said very good buy point sometime in the future. Okay, so of course Asia Pay TV is on the coaxial cable. This company is on a fiber optic. So just that small little differences. Okay, so this Asia Pay TV will be a very good case study on the share price movement. What's going to happen in the next half a year, 1 year. Okay, Asia Pay TV, among all the trust companies, this one was really the best among the rest. Okay, and it did pretty well. Okay, the recent crash was likely due to Taiwan case, that China PRC investors. Other than that, I think this one is still doing fine, not very good, but fine. Okay, so here we are. I'm just going to do some basis on this. Now, my own basis, there's no right and wrong on it. Okay, so reference to the financial year 17 earnings. Okay, in my own perspective, I do think that the dividends payable at max is the net profit and half of depreciation at most, and the interest there's no need to pay further on. Okay, hence I just work out based on all these numbers you can get on the prospectus. I come out to be about 155 million payable divided by units. End of the day, the maximum they can give is 5.3 cents per unit. Okay, but for such company who they're giving depreciation, I will look forward to at least 8% dividends. So with a 5.83 divided by 81 cents, 6.5% dividend yield at max. I said again, at max. So they are they still keep about 1 point something percent as some cash flow towards the company for some growth, because I do see that they're trying to acquire some companies, sorry, some buildings after the IPO. So, but then, okay, so I do look forward for such trust companies at least 8% due to the big significant of depreciation here. Okay, and they're assuming that this company is this thing will be fully depreciated because 25 later, that means this company has become empty company lah. Okay, but it's not empty, just like the Singtel lines around. Okay, next I do need to highlight this very important one. Okay, see the 2018 forecast. Okay, this was based on 2017. I say again, this is based on 2017-155, but 2018 at page 89, the earnings was much lower than the. This was based on 79 mil, was based on 2017. Okay, the 2018 was 44. It's much even lower, so you should be looking at even lesser than that. Okay, so 5.3 cents. So that's why they give out 5% dividend yield. Okay, 5% dividend yield. I calculate here 6.5 based on 1.7. So okay, so that's not very attractive. Okay, because a REIT easily gave me 6 or 7. So now I'm just gonna take based on what they forecast on 2018, based on their 5.43% dividend yield. Just let me get back to here. Sorry, this one is pretty lengthy. Hey, where is it? Okay, 5.43 dividend yield as they forecast for the year 2018. So 5.43 times 81 cents, I come out to 4.39 cents. At share price of the year, we come out to at share price 81 cents, we come out to 5.43% dividend yield. I don't think that this is attractive at all to me. So you can see here that once we go up by a 10-cent magnitude, okay, a 9-cent magnitude, the dividends drop to 4.87, and a lot of REITs far exceed this forecast. So there's very likelihood that it's going to burst above 90 cents. So here to here, low chances, low, I can say low. So now when we look, the REITs in the markets or a lot of business trust Asia Pay TV right now is giving easily 8 or 9%. So all the REITs giving within 7%. So what we can see here, if we go down by 60% to 60 cents, the dividends come to about 7.3%, and this looks pretty decent, pretty fair. All right, given that you're paying out of the depreciation, which the money should be reinvested back. So here we are. Next, even at 50 cents, how this one looks become a good acquisition point, because you know that this 8.7, half of it is depreciation, half of it is really close to earnings. So this company is pretty stable, and I think within this 50 to 60 cents, this is acquisition point. But I do not think it's going to happen within this year, probably next year. Then you can look and consider buying this share to keep and some trading if you want. So you can see it. So this is within this region is a greater likelihood, and this region is a lower likelihood. So I do see that the first day of share price is going to go in this directions. All right. So it doesn't mean the share price is horrible. It just means that shareholders can get a better returns in other places in REITs or even Asia Pay TV. Okay. So so this is what I think. So yes, that's what I think based on the reasonable assumption and the information I can get. Okay, so I think that's about all. It's a very long video, so hope you guys have see if you want to buy the IPO at this present 81 cents. Personally, as for me, I'll just maybe give it a skip, but I'll definitely add it onto my watch list, hoping that I come to this range and just maybe buy some as for dividends. So it's give a pretty good dividends. So yeah, I think that's all, folks.